Councillors, it's gone 9 o'clock. I'd like to welcome you all here to the Finance and Performance Committee meeting for the 21st of May 2026. And I would like to start the meeting to advise members that Huani Langsbury has been appointed as the mana whenua representative for Te Ranga o Otakau on the Finance and Performance Committee. Unfortunately, Mr Langsbury is an apology for this meeting. There have been no public forum requests, and we have, as I said, we've received apologies from Mr Langsbury, and we've also from our other mana whenua representative, Mr Jeffrey Broughton, and also apologies from Councillor Lefiso and Councillor Gary. Are there any other apologies? There being none, I'll put those, all those in favour, please say aye. Oh, sorry, seconded Councillor Mahan. All those in favour, please say aye. Against, motion carried. Confirmation of the agenda. There's been a request to take item 9 ahead of item 6. So I would like to move that the committee confirms the agenda with the following alteration. Item 9, DCHL group update for the quarter ending 31 March 2026 be taken ahead of item 6, overview of Dunedin City Treasury Limited and Treasury Risk Management Policy. Seconded Councillor Vandervis. Going to put the motion. All those in favour, please say aye. Against, motion carried. Declarations of interest. Members are reminded of the need to stand aside from decision making when a conflict arises between your role as an elected representative and any private or other external interests you might have. Are there any updates to the register? Councillor Mayhem.
Could you please remove Fire and Emergency New Zealand? I've completed my 5-year term.
Thank you. So I therefore move that the committee amends the elected members' interest register and amends the proposed management plan for elected members' interest. Seconder, Councillor Vandervis. All those in favour, please say aye. Against, motion carried. Confirmation of minutes. Finance Performance Committee meeting of 19th of March 2026. I move that the committee confirms the public part of the minutes of the Finance Performance Committee meeting held on 19th of March 2026 as a correct record. Seconded Councillor Vandervis. Any discussion? There being none, I put the motion. All those in favour, please say aye. Against? Motion carried. We'll now move on to item number 9, page 75. Dunedin City Holdings Limited Group Update for the quarter ending 31st of March 2026. And I'd like to invite Mr Tim Lone, the chairperson of the DCHL Group. And no Mr Hocking this morning, just yourself, Mr... Oh, yes, busy this morning. So welcome, Mr Lone. Councillors, do we have any questions? Mayor Sophie.
Kia ora, Tim. Just one question around the asset revaluation. I see the last valuation was refreshed at the 30th of June 2024. That's on page 83. But I just wondered when we do get the assets revalued.
So we do the assets every 3 years. Yeah, that's and that's a formal valuation that's done.
In looking at the graph on page 83, that's got the a graph with DCHL group term debt over assets, but your forecasts are just forecasts until they're actually revalued. Is that correct?
Oh no, that's the book value of the assets is shown in that graph as opposed to the market value. So the revaluation is really done for council and our own purposes, just to understand what the market value of those investments is, but it's not used in the accounting valuation, so it's not incorporated within our reports.
Councillor Walker.
Yeah, thanks, Madam Chair, and thanks, Mr Lone, for the report. My question is not certainly in this paper, but it has mentions elsewhere around the city forests. Weather event, and it talks in some depth to the effects therein. What's the insurance status of city forests related to weather events? Just for this event and just generally.
Yes, good question, one I've explored myself in some depth, but unfortunately we can't insure for wind events. So that's and it's something that I would love if we could do that, but we're unable to do that. So unfortunately for this event, no insurance is available.
Is that generally throughout the motto, would that apply to all forestry companies?
Correct, yes.
Councillor Lund.
Mr. Lone, at page 81, I've seen some words that give me some concern around Dunedin Railways. It talks about a reprioritisation of maintenance while key risk areas are appropriately managed. This sounds to me much like we're cutting back maintenance to the absolute core. So I just need some assurance that we are actually maintaining this asset properly, and is there a long-term asset management plan in place, particularly around bridges and viaducts? That's my first question. The second question regarding railways, with the there's been quite a turnaround in the financial results, but does that include the $1 million? There's $2 million a year being paid. Is the reason for the turnaround that accounts for the $1 million of subsidy?
Sure. So in terms of the maintenance question, I can provide you with assurance that there is extreme rigour going into the maintenance plan for Dunedin Rail, and the comments are not to suggest that Dunedin Rail is cutting back on maintenance at all, quite the contrary. What they are doing is reassessing that maintenance plan and making sure it's fit for purpose. There was a presentation last week in which they provided some detail around the work that they're doing, and there was a sense that some of the previous planned maintenance was gold-plated, might be the word that could be used, and so just a sense of going back through that, making sure that it is appropriate, and planning that out. So a revisit of their long-term maintenance plan and projecting that forward. So I can give you assurance regarding that.
If I may, some words around Delta. It's certainly very heartening to see Delta's turnaround, and I would comment that as a contractor, it's great to see that they've decreased their revenue and increased their margin. And but my concern is around the debt. I believe that Delta has $8 million in debt, and for a contracting company, I'm concerned about that because I'm assuming that leases for equipment would be accounted for separately. Is there any plan with the current good performance of Delta to pay back some of that $8 million in debt?
I didn't actually answer your second question in relation to Dunedin Rail, which is that the funding that we provide does not impact their financial performance specifically at all. It's capital funding. Yeah. So
they have had quite a dramatic turnaround, Mr. Lynn.
There has been a turnaround within Dunedin Rail, and that's as a result of it moving back into more operational performance. But yes, we're very happy with that turnaround. It is tracking ahead of plan, but yeah, there's still plenty of work to be done. In terms of Delta, the dividend payment rate is well below their level of profit, so there is an ability for them to repay debt. So yeah, we're reasonably confident. We've gone through their debt forecasts with them just recently, and confident that that is able to be managed and will in fact reduce over the coming period.
Councillor Bandivas.
In the days of the Larson report, it was deemed to be an issue that Delta and Aurora were very closely aligned. They had the same directors for quite some time, and that the contracting by Delta to Aurora was often less than at competitive market rates. Is the situation that we now have, where there was supposedly a complete financial separation of Delta and Aurora, is that still now on a competitive basis, completely competitive basis, or is part of Delta's increased net profit. Is part of that due to better contracts from Aurora?
The arrangements that Aurora has for appointing contractors are completely competitive, and Delta forms part of that contractor group. Delta does receive a reasonable amount of its revenue from Aurora, but that is tendered on a competitive basis.
And that would be the same with contracts from the DCC?
Correct.
Councillor Hall.
Thank you, Deputy Mayor. Talking about City Forest, with the wind damage, are there any impacts expected? Will these impacts be temporary recovery effects, or is there going to be longer term structural concerns with the wind damage, like damage of stock? Is that going to be an ongoing thing, or is that just a one-off event?
In terms of the October wind event, it is a one-off impact, but the impact of that will be felt over this financial year and into next financial year. We don't have a firm handle on how that will spin out over the longer term, but we are confident that they'll get back to a sound position. The impact of that event for them was that they needed to increase their harvesting quite significantly because they had a lot of damaged stock that they didn't want to have lying on the ground and rotting, but the stock was not at the prime point for harvesting, and so it's had a financial impact. It's also had an impact because they've had to up their harvesting of that stock. So it will impact this year and into next. And that's unfortunately just the way it is.
So the impact's been negated by recovering the damaged resources, so you're only really losing the extra growth. Was it a younger population, or was it already pretty close to harvest time?
I couldn't answer that question off the top of my head. What I do know from photographic evidence I've seen is that when the wind came through, essentially you had trees that were snapped off halfway up. So you're not recovering full-grown trees. You're recovering trees that have been snapped off halfway. And then when you think about harvesting those trees, you've got so it's not a normal harvesting operation because there's a lot of debris that you're having to work through in order to get to that stock. So the whole operation is much more challenging for them.
Councillor Sims.
Thank you, Deputy Mayor Lucas, and thanks, Tim, for your presentation. I just want to sort of tease out a couple of things that Councillor Lund asked about. So Delta's quite significant and very pleasing improvement. Is that sustainable, or is it a moment in time, or are we likely to see that to continue?
We believe it is sustainable. Yes, there's been quite a considerable amount of work done within Delta to review the way it quotes tenders, manages its contracts.
The second thing is, and I have the same concerns that Councillor Lund has about the visibility of the performance of Dunedin Railways Limited. The figures that are given in the sort of very, very high level summary table don't seem to square with the cash flow figures, so the company is still cash flow negative, which would indicate that it's still trading at a loss. Can you give us an indication of where their actual trading result is? And the second part to that is that I've never been able to get an understanding of what the motion of council was about that $2 million per annum input. There seems to be some further on in the papers, there seems to be some expectation that that $2 million per year will continue for the whole term of the 9-year plan. But equally, there seems to be some contradiction towards that to what the actual motion of council from 2025 was. So could you fill in those two gaps for me?
Certainly. So look, in terms of their trading performance, and unfortunately, our board meeting is next week, and I don't have the most recent financial information, but I can talk to the information that we received at the last board meeting, which was up to the end of March. So up to the end of March, the trading result for Dunedin Rail was in fact positive, so it was in the black, but that's, as you'll appreciate, just at the tail end of their busy season, and the busy season went really well for them this year. Their forecast to the end of the year is for an operating result that will be around about $1 million negative. So maybe that correlates a little bit better with your expectations, but that's against a budget of $2 million negative. So they have traded exceedingly well relative to their plans, and they are very motivated to turn that business around. So they are working extremely hard to do that. Sorry, I had your second question, and then I've just lost it briefly. Sorry, Councillor Sims.
Microphone.
I think you've answered that question. Sorry, I think you've answered that question. No, the second question was that further on in the papers there seems to be an expectation of that $2 million per year.
Yep, I've got it. Yep. Sorry, I just had a momentary lapse. So you're right. There is a little bit of confusion around that, and my understanding of the way it operates is that DCHL has been asked to provide up to $2 million of funding per year by way of capital injection, and the funding is for track maintenance. So if we think of the rail corridor through to Middlemarch. So that's what that funding is specifically for, and that is for the entire period of the 9-year plan, so $2 million per annum. Where a little bit of confusion, I think, exists is that for the first 2 years of that, DCHL was given the ability to reduce its dividend to council. So there was an agreement that the dividend to council would be reduced for the first 2 years of that. So year 1 is the year that we're currently in, FY26. Year 2, FY27, is the second year of that. And so the dividend, which was previously $11 million, was reduced to $9 million to compensate for the $2 million capital injection. Beyond that period, the $2 million capital injection comes from DCHL without an expectation that that would impact the dividend to the city, if that makes sense. Oh, sorry.
Yeah, and I guess the other component there is we're injecting that cash by way of equity, so shares in DRL, and it's up to $2 million. So the forecast trajectory for DRL is to improve their operational performance and generate operating cash flows themselves, which can then fund that ongoing maintenance. So based on the budgets from last year, and they're being refreshed as part of the statement of intent process, based on last year's figures, that the $2 million from DCHL in additional funding was only required in the first 2 years, because following that, the combination of subvention payments within the group and then the improved operational performance generating operating cash flows meant that $2 million wasn't required in those out years. So that's where we want to be, because that's where the DRL business becomes self-sustaining, in that it can fund its own capital maintenance plan.
Okay, sorry, and if I could just follow that up with not quite a question, but my concern is around, look, I saw on South Road's Facebook page that they had undertaken the replacement of bridge beams on the Wingatui Viaduct, which I celebrated because that's been a real concern for a long time. But the Holmes and Vitruvius report also states that the bridge beams on 5 other bridges need replacing as well. And the danger I can see us getting into here is if we haven't done anything until we've done the whole job, and that's the concern that I have, that we could ultimately be wasting money at the moment if the council made a future decision to not continue with that, picking up all of the deferred maintenance that's required on that rail corridor, because you're only as good as your weakest bridge beam. So that's the intent of the company, is that?
So the company's planned out its maintenance over a long period of time, and we've had a number of reports prepared. We have a very competent director recently appointed to Rail as well, who has gone through all of those reports, been out, inspected the track himself, and met with the various consultants and engineers that have provided reports. He provides expert opinion to us as well. In terms of his opinion, he's very comfortable with the work that's been done, but it has been identified that there is opportunity to change the way in which some of that maintenance is phased over that period of time. So there is no need to do all of the work right now, but there is a need to continually maintain and update the track over the next period of time. That's ongoing, but we've looked at over a reasonably long period of time in terms of that. So we certainly as directors have confidence that the work that's been done is appropriate, and that the health and safety risks associated with the rail are being managed adequately.
Councillor van der Bus.
On the same issue, Mr Lone, you said just a little while ago that up to $2 million of capital injection was for the rail corridor through to Middlemarch. Is some of that $2 million being spent all the way to Middlemarch, or only for the length of track currently used?
So that the lease that Dunedin Rail has with the Crown is for the rail corridor all the way through to Middlemarch. So I think it's around about 63 kilometres of track. So that's what I'm referring to. There is no money being spent on the track past Pukerangi at the moment. There is intended to be investigation around whether that can be opened up and what opportunities there would exist through to Middlemarch, but that work is not currently happening.
There is some small amount of spending on the Middlemarch railway station, though. Is that the case?
So Dunedin Rail are in discussion with community groups who have a strong interest in the railway station, and there is an intention to have maintenance work done on the Middlemarch railway station, and Dunedin Rail will be a party to that. So we are expecting that there will be some spend from Dunedin Rail to help with the work that's required with the Middlemarch station.
Councillor Chambers.
Yeah, I'm just wondering, in something like a railway and bridges, etc., is there a separation between maintenance and infrastructure? There's some things are maintenance, some things are infrastructure, and perhaps they would be funded quite differently.
I think with any business, if I'm interpreting your question correctly, there's a capital component and then an ongoing maintenance component, and so that does need to be managed. The bulk of the work being done by Dunedin Rail is more of the maintenance type work as opposed to new capital spend. I think the one area that they are looking at is around their workshop, so there could be some capital expenditure in relation to a workshop, because as you'll be aware, they are doing a lot of their maintenance out of a tent at the moment.
Councillor Walker.
Thank you. Pivoting away from railways, my question is slightly motivated by NVIDIA's announcement this morning of an $81 billion quarterly revenue announcement in the US. So back to our $100 million plus Waipori Fund, and the papers suggest that the next couple of quarters there'll be the long-awaited review of the SIPO investment. Is that how far along the line is that? How far into the work are we, and when will we get eyes on it?
So we are well advanced on that work, and we are intending to hold a workshop on the 9th of June with Council to work through that.
Are there any further questions? Oh, Councillor Lund, have you got a question? Yes, Councillor Lund.
And just returning to Delta, I believe we've got Delta said they've got $1.5 million in capital spending this year. Is that? Can you give us some idea about what that is? And also, has the DCHL board discussed with Delta the idea that they may want to expand their operations into the Three Waters sphere, or extend their operations, given the council's long-term program there?
I don't have detail on the $1.5 million of capital spend for Delta, but we can get that information unless you've got.
I don't have it.
Okay, so we'll just take a note on that one, Councillor Lund. In terms of Three Waters, I think that's certainly an interesting concept. What we have asked the Delta board to do is think very strategically about that business and where opportunities exist. That's not one that has had a lot of airtime at this point, but I think, you know, it's a company with a good workforce, and they are starting to show some real discipline around contract management. So there is potential there, I would have thought, but not a strategy that we have explored in detail with them at this stage.
I think it would strengthen and, you know, done well, it could really yield significant results to the council, because I think we do suffer from a lack of competition in a lot of areas.
Mayor Sophie.
Kia again, could you just tell me a little bit about the intern director program? Have you had a good number of applications for that?
Thank you, Mayor Sophie. Yes, we have. In fact, a surprisingly good number of applications. I think last time we had 44. This time we've had 99 applicants for the program. So it's been a fantastic result, a little bit challenging in terms of working through that. So one of the things we are looking at with the Institute of Directors is, because we've only got 6 roles to fill, that means there's 93 disappointed people, is what we can do for those other people in terms of providing opportunities for them to grow in their governance career. So we're looking at options that are not really going to necessarily cost any money, but we're hoping that we may be able to use, for example, the art gallery here and put on a function with speakers to help those aspiring directors just get an understanding of what's involved and paths that they might be able to take. But yes, a really good result. We've interviewed half of the shortlist, and we've got the remaining interviews to go. Thank you.
Councillor Treadwell.
Tēnā koe, Madam Chair, and tēnā koe, Mr. Lone. I just had an airport-related question, which is on page 81. It's just noted that the Air New Zealand has reduced the Dunedin services by 7,700 seats. I'm just curious if we expect that figure to, or if you have any indication of whether that figure will hold or might increase or decrease according to fuel availability at present.
Unfortunately, I don't have any information on that. We're continuing to monitor the situation, as are the airport, and they are engaged with Air New Zealand around that as well.
Appreciate that. Thank you.
Councillor Gaylor.
Just going back to Dunedin Railways, you talked about the maintenance beyond where the train stops currently. What is the time frame for that?
At this point in time, we don't have a time frame for any potential opening of the track through to Middlemarch. It's a little bit challenging in terms of the fact that it's a 5-hour journey now, return, and so extending that journey through to Middlemarch will extend obviously the time of the journey, and that has implications around I guess for example cruise ship services, etc. There's also a desire to work with the Otago Rail Trails Trust in terms of connection with the Central Otago Rail Trail, and just how we can make that work. So options are being investigated, but it's not a priority item for Dunedin Railways at the moment, because they are very focused on getting the business back into a sustainable position first of all.
Thank you. So it's sort of slowly as she goes. Just one other question around the marketing. They're doing a great job, by the way, just looking at their marketing. But is there a decent budget for that for them?
I think they've certainly increased the budget for marketing, and they're doing a lot of work in that space. So yes, we're comfortable, and I think they would come to us if they needed to increase that. But they're also conscious that they've got a bottom line to protect as well.
Thank you. Any further questions? I don't think so. Thank you, gentlemen, and that was very informative. And so I'd like to move that the committee notes the Dunedin City Holdings Limited Group quarterly update for the period ended 31st March 2026. Seconded Councillor Mayhem. And I would just like to say that it's very reassuring to see Dunedin Railways and Delta both been in a good position, at the end, 9 months in for the year, and overall the group position ahead of budget, and I think that's gives us great reassurance in terms of paying the dividend that obviously helps offset rates. So thank you for your work with that. Is there any further speakers? There being none, I'll put the motion. All those in favour, please say aye.
Thank you.
Against? Motion carried. Thank you, gentlemen. That's great. So we will now move back to item number 6, overview of Dunedin City Treasury Limited and the Treasury Management Policy. We have a presentation that's going to be made by Richard Davey, the Treasurer of Dunedin City Treasury Limited. So I'll ask Mr Davey to come forward, and Ms Allen, our Chief Financial Officer. Thank you. Welcome, and the floor is yours to take us through this.
Great, thank you. Good morning, everyone. We'll just go through these slides just covering Dunedin City Treasury and what the company does for the group. And if there's any questions, please let me know as we go through. So, right, so that's the list of contents there. Right, so Dunedin City Treasury sets out to achieve the following. Ensure adherence to the Treasury Risk Management Policy, and the policy is included as part of this item a little bit later on. So Dunedin City Treasury arranges all the debt for the group and issues debt securities in the name of DCTL. And DCTL on lends to all the entities in the group. We manage the interest rate risk for the group, and there's a graph showing our interest rate risk management a little bit later on, and we're also the fund manager for the Waipori Fund. Okay, so at a high level, the Treasury Risk Management Policy sets out the parameters for the following. For funding, it sets limits like having no more than 450 million of debt maturing in any 1 year. It sets out our liquidity requirements. The interest rate risk management parameters, sets out the foreign exchange policy, commodities, credit and investment. And we report compliance with the policy every month to the DCTL board, and also every quarter to the Audit Risk and Assurance Committee. Right, so as we've mentioned, we undertake all the borrowing, but DCTL and DCC are both rated AA- by Standard & Poor's, and that's a key aspect of how we borrow, or the assistance that it provides us to borrow. And the typical terms of the debt securities that we issue are between 3 months and 10 years. And the investors in those securities are local fund managers, wholesale investors, banks, and the LGFA. And we issue vanilla floating rate notes and bonds. Vanilla debt products are the least expensive, they're simple and generic, whereas non-traditional financing mechanisms and other derivatives incur additional charges to compensate banks for the additional risk.
Councillor Sims has got questions now.
Sorry, thank you. I was just wondering very quickly at the split between the investors and DCTL paper, and then you've got four of them lined there. What's the ratio?
The LGFA is probably about 45%. Of about 1.5 billion of debt on issue, we've got 230 million short-term borrowed via P notes, and the rest is split. There's a few large investors who would be about half of LGFA's exposure, and then the others are spread probably between about 30 or 40 different names.
And we never have problems selling our paper?
No, we don't. There seems to be a shortage of corporate bond paper in the New Zealand market, and we're probably a relatively smaller issuer in New Zealand than a lot of other issuers. So we don't have any problems, no.
Councillor Vanderbilt.
Mr. Davey, you've mentioned the Standard & Poor's ratings up there. What you haven't mentioned is the negative watch that we've had, I think, for the second year running. Can you explain what the negative attachment to those ratings actually means?
Yeah, so the negative came about in about February last year, and Standard & Poor's reassessed their outlook for the institutional ratings rating score measure. And previously it was extremely strong, and now they just attached a slightly weaker ratio to that, and mechanically that meant that we got put on negative watch, along with about, I think it might have been about 18 other councils.
So that's 18 out of 78 councils, is it, that are on negative watch now?
I think that's about right, yes.
Does that negative watch actually adversely affect the interest rate that we end up paying, or is it just sort of heading in that direction?
It increases the interest rate by 0.05 when we borrow from LGFA, and other investors probably command a few basis points more than what they did previously. But overall, we still don't have any problem accessing funding at all, and there's still a very, very strong demand for our paper.
Councillor Lund.
So, just to be clear on that, with the LGFA funding comprising 45% of our lending, it does say that S&P say that there's an extremely high likelihood of the government coming to the rescue should there be an issue. So can we take it that we are getting a noticeably lower rate with the LGFA funding than the rest of than the other funding for equivalent terms?
No, it's about the same. Sometimes other funding's a little bit less expensive, and other times the LGFA is a bit more competitive. It really depends on a case-by-case basis.
That would seem to be not logical if we've got an implicit Crown guarantee, as Councillor Ong loves to remind us at every opportunity. So that's effectively of not flowing through to a benefit to council in the marketplace, then, is it?
There's no government guarantee of the LGFA or council debt.
No, but the credit rating says that there's an implicit guarantee there, and they rely on that. They've said that in their report.
Yes, they say that in the likelihood of a stress scenario that there would be extraordinary support from the government, but there is no guarantee as such.
If we weren't in the LGFA, then that wouldn't make a material difference to our ability to fund our paper.
No, I suppose the advantage that LGFA gives us is diversification of funding and term of funding. They're very good for providing very, very long-term funding, and they're always there under all scenarios. And when there's market disruption, the LGFA is always there.
Miss Sophie.
I just wonder whether it would be possible to have questions at the end, given that some of the questions that have been asked are actually addressed in the upcoming slides.
Yeah, I was thinking the same thing. And are you happy for that, Councillor Vanderbilt, or is there something particular you just wanted to ask right now?
Oh, there was something I wanted to ask particularly.
We'll just take that and then we'll do questions at the end. I think it'll be helpful.
Given that we don't really have any particular interest rate advantage from using LGFA, but under the LGFA contract, we are liable for the financial failure of any other council in the LGFA. If we're not getting any real advantage in terms of interest, what is the rationale really for staying with the LGFA, given that contractually, if Auckland or another large council was to go down, we would end up bearing the brunt?
It gives us diversification of funding, and at times debt markets shut down and you can't access them, like after, say, September 11, the GFC, the Asian crisis, those types of events. And if it's difficult to get funding, it can become problematic. So the LGFA gives us that strength and ability to fund at any time we wish, and for a very long tenor or term.
So there is no real interest rate advantage. There is real liability potential, but it's that simply that diversification would be the justification for staying in LGFA.
Yes, definitely. And if there was, if a council defaulted on its debt, there are arrangements which the LGFA would make to recover that debt over time. It becomes a timing issue, really. Okay, so security for investors in the LGFA. So when we joined the LGFA, the DCC joined also and became a guarantor of the LGFA. So there's basically two main documents. So there's a debenture trust deed between the council and the LGFA, which covers the security over rates income, which they have, and that's not security over residential houses or any other property. Then there's the debenture trust deed, which is for the benefit of all investors, and that provides security over for DCTL's borrowings over DCTL, DCHL and Aurora Energy, and in the debenture agreement is the details of our uncalled capital structure, which is 1.9 billion, and that really is for shares issued by DCHL to the council, which are unpaid for, but it provides security to investors. It really is the mechanism which gives DCTL the ability to borrow instead of DCC doing the borrowing as such. Next one. So we've covered that really, and the next review date of uncalled capital would be in line with the next 10-year plan, and after that 10-year plan is approved in July 2027. And the 1.9 billion is a self-imposed debt limit, so it's the debt limit which we set so that we can go and borrow the money for to cover the 10-year plan and the borrowings of the companies. Now the LGFA, so if we go back, so the council has the ability to borrow directly from the LGFA if it wanted to, we guarantee the debt of the LGFA to LGFA's creditors, and DCTL joined as a council-controlled organisation as an issuer, and I think we were one of the first CCO issuers to join the LGFA, and the obligations that we've got to meet with the LGFA are the quarterly reporting obligations, and also we've got to comply with the covenants as measured on a group basis. And those are the LGFA covenants there. So if we just move on. Right, and how does our credit rating work? So there's a number of rating score measures which Standard & Poor's rates all councils in New Zealand on, and those are institutional framework, and all the councils get the same rating for that. There's the economy, which we can't really control. There's financial management, and that's largely a qualitative measure, budgetary performance, liquidity and debt burden. And they assign a number to each one of those measures and apply a weighted average to it, and the weighted average of those rating scores determines our credit rating. And so, say for instance, the weighted average of those numbers might be a 3 or a 3.2, and then that number will determine where we are, AA minus, AA, and so on. And those are a summary of our rating score measures when our credit rating was last determined, which was the end of last year. So institutional framework is a 2, budgetary performance is a 4, debt burden is a 4, and that produces a AA minus credit rating, and we are on negative outlook. So the LGFA, their credit rating is AAA, the same as the Crown, and there's a couple of key points there. LGFA debt is not guaranteed by the New Zealand Government. The New Zealand Government is a 20% shareholder of the LGFA alongside other councils. We're not a shareholder of the LGFA. And as it was mentioned before, Standard & Poor's recognises that an extremely high likelihood of government support in a stress scenario. And the LGFA has a committed facility provided by the government of $3 billion, and that's managed by the Reserve Bank. And also the last point, important to note as well, is that council debt is not guaranteed by the New Zealand government. And that's, there's a section 121 of the Local Government Act, if you'd like to refer to that. So DCHL provides debt facilities to the group, all on an unsecured basis, and they're documented with binding facility agreements, which are legal documents, and those facilities and borrowings from the group are managed by DCTL, and they come in and borrow from us on a day-to-day basis, repaying money, drawing money, and we manage those debt facilities in our Treasury system, which is called Treasury, and we manage all the group's other external financial markets transactions. Here's a summary of the composition of borrowing within the group as of 30 June 2025. And you'll see the graph there provides a bit of detail about the composition between DCC and Aurora, and you'll see in the latter, further out years that the borrowings still are increasing and the DCC debt, or proportion of that, is plateauing. And managing the Treasury policy, we've got specific limits, as we mentioned. We can't have any more than 450 million maturing in any 1 year, and we target having at least 20% of debt with maturities longer than 5 years to minimise our refinancing risk. And we've got specific interest rate hedging ratios which we've got to comply with. And the next review of the Treasury policy will need to be undertaken shortly, ahead of the 27-36 10-year plan. That's a summary of our interest rate hedging there. The blue line along the top is total debt forecast of the group. The vertical histograms show the actual interest rate hedging that we've got. And the grey horizontal lines which step down are the minimum and maximum hedge ratios, and the red is just the midpoint between the minimum and maximum hedge ratios. This picture really illustrates how an interest rate swap works. The red horizontal line represents an interest rate swap of, say, 3.25%, and our debt is largely sourced on a floating interest rate basis. So when we enter into a swap contract, we enter into the obligation to pay a fixed interest rate in exchange for receiving a floating interest rate, and the floating interest rate that we receive as part of that swap offsets the floating rate that we pay on our debt. And so the residual interest cost is the fixed rate of that swap contract. And we have lots of interaction with the DCC, sorry about that, and the council. We work very closely with Carolyn's team, and we provide the outlook on interest rates, manage the Waipori Fund, and report on compliance with the Treasury risk management policy. Yeah, and that's it. And after this, the Treasury policy is there for any questions or comments.
Thank you. I think that's been really informative, because it's quite complex and it's hard to get everybody's head around, and I think it's really helpful to have this presentation today. I know we have some questions from councillors. Councillor Vandervis.
You've said that we have self-imposed a 1.9 billion uncalled capital limit. Is it not the case, though, that that self-imposed limit has been routinely overspent every couple of years for quite some number of years now, and is planned to again be completely breached within a couple of years? And we're going to have to again increase this supposedly self-imposed debt limit.
It really is the mechanism to enable us to borrow what is in the budget. So it really is the debt limit that has to be put in place to put those borrowings into effect. And so if the group borrowings increase above the 1.9 billion, and that's approved to do so, we have to enable that by increasing that limit.
Councillor Lund.
And Mr. Davey, I note there's no minimum limit for long-term debt. Has that always been the case? We've got 80% 40 and 20 in the minimum limits for short-term debt, but nothing for long-term over 5 years. Has this always been the case?
I think it has been for a very long time. I suppose the thought around that is that interest rate cycles tend to move in a 2 to 3 year cycle, and because of the term structure of interest rates, very long-term borrowing and interest rate hedging incurs a larger cost, and so it can be recycled over time and more cost-effective.
Thanks. Regarding the hedging, it's interesting to look at the slide we just looked at, which showed, we were in the red for about 12 years straight, ranging from very small to quite severe losses. But then we had a big win in the last 2 years. How does that? Do we have any limits? We've got a Treasury risk management policy, which I'm sure Ms. Allen will tell us about. How does our hedging? Do we have limits that we sort of work towards in our policy? The term is key indicators that the policy refers to. Do we have one for hedging?
We have the minimum and maximum hedge ratios, and also one thing that DCTL does is we look at where interest rates are historically versus long-term means, and if there are a certain number of standard deviations below the mean, we're more active. If there maybe 2 standard deviations below the mean, we would be very active, and if there are 1 standard deviation above, would be more conservative around entering into interest rate hedges, and we look at those details on a daily basis.
Councillor Treadwell.
Thanks.
Tēnā koe, Madam Chair, and tēnā kōrua. I was just looking at page 3, composition of the borrowing within group, and do these, the composition of group debt says it's largely increased for funding infrastructure investment of DCC and Aurora. I was wondering if these figures are affected by the divestment from DCHL to the DCC, or the return that we demand from them.
So in terms of dividend payments and so forth? Yeah. They would be impacted by those. Yes, I suppose when you consider, say, the amount of dividend payments, they probably don't have a large impact, just given the quantum of the borrowings currently in forecast.
So I guess just, even if it is a small figure, do these graphs reflect the current dividend payments or the previous level of dividend payments?
Yes, they would do.
Councillor Chambers.
Thank you. Yeah, the concept of uncalled capital must have gone over my head during induction, because I found this slide a bit daunting when I first saw it. This concept that of $1.9 billion. Now, could you tell me, are there any circumstances in which uncalled capital ever gets called upon by companies? And the other thing is, what happens to uncalled capital in the event that you sell a company?
In terms of uncalled capital, in terms of being called, there used to be the funding between DCC and DCHL used to be done via a call and uncalled capital, and it was simultaneously increased at the same time. But that's done slightly differently now. And in terms of if a company's ever sold, I suppose we'd have to consider that at that point in time, but we would have to get approval to sell any company that was part of the debenture agreement.
So can you actually just cancel it? As though it doesn't, if you can just cancel uncalled capital?
You couldn't, because it's the security for the debt on issue that we've got. So if we cancelled uncalled capital, you would wipe out the security which investors have got. So we couldn't do that.
Me, Sophie.
Thank you. I just have a couple of questions around the Standard and Poor's rating. There was something on the radio and things that have been happening within New Zealand. I'm referring to page 11 of the presentation. I guess it's page 30, and it's talking about the key rating factors. Institutional framework and economy are the ones that I am, I guess, specifically concerned about here, which is around if there is a rates cap put on councils, does that affect the institutional framework score? And I don't know how they measure that, if it went from a 2 to a 3, and then also around the economy, because on the radio, RNZ, they were just talking about how it's possibly going to take around 2 years to recover from for the economy to recover. So when we come to our next Standard and Poor's, should we be concerned around the institutional framework and the economy affecting our scores there?
We've spoken to them about those measures, and the move from a 1 to 2 with the institutional framework was, quite a significant move. But to go from a 2 to a 3, we understand that would be quite a large event for that to happen, and it's unlikely in the near term. And that was when the information about rates cap was out there and known about at that point. And on the economy, that's not one that they change very often either. And that's probably taking the current environment into consideration. So I think it would be unlikely for those two measures to deteriorate in the near term.
Councillor Lund.
Just following on from that, I know that S&P in their reports refer to governance and accountability as an important factor in there, which we don't have in the slide report. Would that be construed as being part of the institutional framework?
I think that would really be under financial management, and that's kind of the qualitative measure around governance and so forth and things like that, but could come into the institutional framework. The institutional framework is largely around the ability to rate and the power that councils have got to apply rates.
But it is true, though, isn't it, that governance and accountability is important to S&P?
Yes, very much so.
Councillor Sims.
Thank you, Deputy Mayor Lucas. Going back to page 30 again, I thought I was about to lose my question to Mayor Sophie, but I didn't. The two numbers that made me sit bolt upright in bed when I was reading this was the budgetary performance, where we scored 4, with 5 being the worst and 1 being the best. We scored 4, and also debt burden, and it's particularly the last one, the debt burden, where we scored 4, with 5 being the worst. So it's not too far to go there. Given some of the issues to come up later in this meeting today, should that be a grave concern to us, that we're rated as poorly as that on those 2 key metrics?
I think it's something always to keep in mind, and that decisions regarding capital expenditure do impact ratings and rating score measures, and budgetary performance is about balancing the budget, and is it done over time relative to expectations and things like that. And the debt burden is around ratios like debt to total revenue and interest as a percentage of total revenue also. So it's around those key ratios and measures.
Thank you. So in respect to the answer that you gave to a previous question, what would it take for us to get to 5 when the debt burden? I mean, we're buckling a bit now, but then we've got some proposals ahead of us that will increase that debt burden. At what point do we get the maximum score?
They've indicated that if debt to total revenue was to exceed 240%, that would be a trigger, and also interest as a percentage of total revenue if that was to go above 10%. So if you look at the Standard and Poor's ratings reports, they've got specific details in there of what would trigger a downgrade, and those 2 numbers are key.
So,
Oh, sorry, I just wanted to add to that too. In a scenario where you had rate capping and had reduced your rates revenue, but didn't reduce your expenditure, instead you increased debt, then that would worsen our situation there.
thank you, Carolyn. That's actually a great point that I hadn't really sort of teased out, but I think that's really important to the conversation. Sorry, and if you just indulge me the last one, and this goes back to Mr. Lone's presentation to some degree, but it's always struck me that we undervalue our assets, and if I look at the valuation of DCHL's assets, would appear to be that they're sort of valuing them or putting them on the books at net value, net asset value, as opposed to their true market value. If we were to take a more optimistic view of the value of those assets, would that impact on our credit rating at all?
I think they're probably more concerned with revenues and revenues over the next 3-year period and so forth. So we provide them with comprehensive forecasts over the next 3 years. So revenue's probably more important to them.
Councillor Hall.
Thank you. I worry about still on page 30. I worry these numbers in isolation are a little bit misleading. We may need more context, maybe how we stack up with other councils in there as well, because just seeing numbers like 4 in isolation, like how do we stack up against other councils? Are we above the average, below the average?
Yeah, I suppose probably difficult to say off the cuff without having the other information in front of me. I suppose the best credit rating that other councils would have would be AA, and we're AA minus with negative outlook, so we are rated very highly amongst other councils, and we are one of the stronger councils out there as such.
Yes, Sophie.
Just going back to that, for budgetary performance, that's based on past performance, is it? Because we had a number of years, I think about 3 years with unbalanced budgets where we were trying to catch up generally on depreciation. So now that we are moving towards a balanced budget, would that possibly impact on our budgetary performance score?
I think so. I suppose when we provide them information, we look at the coming 3 years as well. So they would take all of those things into consideration, past and future, and make a decision around that. I think a lot of their measures have like a rolling average as such. So if you improve over time, it will positively impact your score, but it might take a little while to catch up. Yeah.
And my other question was just around Councillor Sims brought up market value of the companies, and I asked before around the market value, which was last done in 2024, and Tim Lone indicated that it was going to be redone in 2027, but you think that it's actually the cash rather than the asset value that impacts on our rating. Would that be closer?
Yes, I think that's fair to say. Yeah, it's about revenue really, and so revenue indicates how you can service your debt, which is the key consideration. By the way, we have actually got a list of the credit ratings of other councils in the country too, which we can provide as well, if that would be useful.
Thank you. That would be useful, I think, if you could circulate that. Councillor Walker.
Thank you. It's partly a memory jog exercise. Correct me if I'm wrong, please. So it's my understanding that obviously S&P are very focused on revenue generation for good reason, I think, in their ratings. When we received the negative outlook downgrade, was that, from my memory, that was partly because, or mainly because they had concerns about us as an authority having an ability under the rates cap going forward to be able to generate revenue. Was that part of that downgrade? You're nodding your head negatively. I thought that was a factor. There was just concerns around that revenue generation.
The ratings downgrade was actually before that and occurred in February 2025. So it was before the talk of the rates cap, and the talk around the rates cap came later that year. So we haven't seen any ratings action yet with the rates cap.
So remove that part of my question, but there was some talk at the time that there was concerns generally for local authorities around their continuing ability to raise revenue. Is that my understanding, or am I just completely thinking of something else?
No, I think that they are very focused on that.
Councillor Lund.
Just very quickly, Mr. Davey, I've seen somewhere in this report that we've borrowed $82 million less than we had forecast this year. So I know that's was likely to flow through into the next budget year. So when we get our next S&P review, will that make a material difference?
I would say they would consider that a positive. So that's DCC borrowing less off DCTL, but borrowing less is considered positive.
Would it be enough to move our rating?
I think it would be unlikely, but certainly macro decisions for 10-year plans and so forth, and the like could have a significant impact.
Thank you. Is there any more questions, councillors? I think that's been really helpful, and I really appreciate the time to put that presentation together for us. So thank you, Mr. Davey. Thank you, Ms. Allen. And so I would like to move that the committee notes the overview of Dunedin City Treasury Limited and the Treasury Risk Management Policy. I'd like to second Councillor Vandervis. Are there any speakers to that? Councillor Sims.
Thank you, Deputy Mayor Lucas. And I also just echo the depth of the information that's put in front of us. And I just want to make a point that this is incredibly important right now, and having this information is incredibly important right now as we face the potential of the reorganisation of local government. So I did a fair bit of work over the weekend, and look, I was pleasantly surprised that, in my view, Dunedin City Council is one of the wealthiest councils, certainly in Otago and Southland, and probably easily the wealthiest council in Otago and Southland. And I did some numbers over based on what the sort of the net value or the likely sale value of our assets would be. And if we sold up everything today, if we stopped Dunedin, sold up everything, cashed everything up and paid all our debt off, we'd still have slightly over $1 billion in the tin at the end of that process. And why that's important, that's not important just so I'm not trying to make everybody feel good about ourselves, but why that's important is we're now being asked to partner with other councils who are in nowhere near that sort of position, and in fact, in particular with one council who's almost in the opposite position. So I think it's absolutely essential that and it's very difficult to try and assess the value of other councils, because a lot of the figures are sort of obscured, probably deliberately so. But we have councils around us who would be in a negative position if they sold everything today, and we have to be incredibly wary about the outcome for Dunedin ratepayers of these potential partnerships that may be forced upon us. Because I, for one, don't feel like necessarily giving up that position. So I think, I really sort of value the information that's been given to us, and I think we all need to be alert to that prospect. Thank you.
Any other speakers? There being none, I'll put the motion. All those in favour, please say aye. Aye. Against? Motion carried. Thank you. Moving on to item number 7, the Local Government Funding Agency Covenant. I'll invite Ms Allen and Mr Davey back to speak to the report, which is a great follow-on from the background that we've just had on the Treasury Risk Management Policy. So welcome, and do you have any opening comments for us?
Thank you. We're happy to go to questions.
Mayor Sophie.
I was looking at the covenants that apply to councils with a credit rating of A or higher, and given that we've just been talking about credit ratings, I wonder, are there a whole lot stronger covenants that would apply to councils with a credit rating lower than A? Would I be able to find them online, would I?
Yes, you can find them on the LGFA website, and yes, the covenants are more stringent on lower rated councils. So the covenants that we have to adhere to are the foundation policy covenants.
And my next question, it actually relates to the graph on page 91, which is around debt profile, given that we are talking about funding across both council and DCHL. When we look at that graph, it looks like DCC debt, I'll say, remains fairly stable. The water debt increases and the Dunedin City Holdings debt increases quite a lot. Is that one of the reasons for looking at requesting a change to the covenant, is actually what the debt profile is looking like in the next 10 years? That's the graph on page 91 that just shows the bar graph.
Yeah, that's correct. And so the debt profile increasing is largely due to the DCHL part of it, and the council debt does plateau, but council debt does increase in the near term. But it's probably really around the composition of our interest expense, net interest over rates income, given that a very large proportion of our debt is unrelated to rates income. It really makes good common sense to remove that covenant if possible.
Just a question of clarity, because a lot of the debt is related to water. So is water income, because we have to ring fence it, is it considered is it called rates?
Yes, it is. And in the covenant, we can also include our water meter revenue in that covenant calculation.
So does that make it more challenging as well? Because some councillors have gone to CCOs and put their water out there and it doesn't affect their rates taking, shall we say, but we have ring fenced it within council and still called it part of the rates. So is that part of the complexity of the funding that we're looking at?
It probably doesn't make any difference if it was still part of the group. It's more that we've got this interest expense that isn't related to rates income of our CCOs currently.
Councillor Lunt.
Just following on from Sophie's question, I see that Mr. Lone in his letter to you, Mr. Davey, talks about that we are still comfortably within our covenant, and in fact the covenant reduced from 23.4 to 21.9%. This is on page 63. And we do have further continuing rates rises that are going to allow for more borrowing on that covenant. So what year, where is the pinch point on the graph? At what year are we looking to breach that covenant?
We're not looking to breach the covenant.
What if clearly we're going to breach the covenant because we want to get rid of the 30% covenant? So, at what point would our debt in the future would it exceed the 30%?
We don't have any forecasts that show that it would breach at the current time. It really is probably a good common sense approach to remove the covenant, because the other LGFA covenant, where you have interest as a percentage of total revenue, is more logical for us, just given the composition of the group.
But if there's no need and we're not breaching it, why do we want to go to the expense of doing so? And isn't it true that, any time an institution wants to change its covenants, the financiers here starts to stand on end? It's,
I suppose with the concept of a rates cap, it would make sense to remove that covenant, because there is the other covenant, which is interest as a percentage of total revenue. So it just makes more sense. If you look at the other councils around the country, not many of them would have large assets like Aurora Energy, and all their interest is related to rates income, as compared to us, where it's significantly different.
It's true, isn't it, that Christchurch Council and Auckland Council have large CCOs with income-producing assets, and so do we know, for example, if Auckland, they left LGFA, did they attempt to change those covenants? Because I for one don't think that the LGFA didn't think of this.
It's difficult to talk for other councils. and the Auckland City Council does still borrow from LGFA. But if you look at the net interest over rates income covenant, our covenant, say around 21 to 23, other councils might be 5 or 6. So it just looks completely different. And so the better measure for us is to use the other covenant, and that provides a good indication of our interest expense to total revenue.
I have a question. Was this not referred to at the time when we made the decision regarding Aurora that we would need to address this by retaining the ownership of Aurora, that we would need to look at our covenants and talk to LGFA about that, because the need for Aurora to continue to borrow more?
Yes, Deputy Mayor, that's correct.
Thank you. Mayor Sophie.
I just want to check, I just looked on the website and it says that Christchurch City Council and Auckland Council are members of the LGFA Shareholders Council, so they are actually members, they haven't left LGFA.
Yes, that's correct, they're still members, and Auckland's percentage, I think, is limited to a cap of something like 42% or 40%.
And just regarding Christchurch, so the Treasury company, it doesn't operate in the same way that ours does, where our Treasury company is borrowing all of the debt, including the debt from LGFA. In the case of Christchurch, it's Christchurch City Council borrowing from LGFA. So the covenants are different there.
Councillor Sims.
Just referring to page 30 where the options are given, was it intended to show that this could constrain future spending as a disadvantage as opposed to an advantage?
Sorry, where are you referring to, Councillor?
Top of page 63, it suggests that if we don't change our covenants that this could constrain future spending. I guess the point I'm trying to make is that some people might see that as a good thing, particularly in light of the answer that was given to Councillor Lund, that we're not in any imminent danger of breaching that covenant anyway. It could feel to some of us that we're trying to defeat the intent of the rates cap perhaps by doing this.
Sorry, we're just struggling to find where you are on the agenda papers.
Page 63, option 2, status quo as the heading.
Yeah.
Oh, okay. Oh, I'm sorry. Sorry, page 60 of the... Sorry, I'm looking at the wrong thing. So I'm sorry to mislead you. It's page 60. Yes.
Yes, you're correct. Thank you.
Any further questions? Me, Sophie.
This is a request from Dunedin City Treasury from Tim Lone, who's the chair of DCHL. So I'm sorry that Mr. Lone's not here to actually talk about why he is requesting this on behalf of DCTL, and it seems quite clear. Can you just define the letter a little bit more about what they're asking for? It just says this provides a more realistic representation of the DCC group's interest composition, where a large proportion of interest expense is unrelated to annual rates income. So that's really the clarity that Mr. Lone's seeking, is it? Because he says that if they're not receptive to that, they're looking at an alternative approach to modify the covenant. So would is this really from the directors asking the council to do this?
It's really suggesting that, well, I suppose I'll give a bit more clarity. So with our covenants with the LGFA, the council has got to be compliant with the LGFA covenants as measured on a group basis. So really it's and DCTL is obviously works within those covenants as well. So it's really just suggesting that DCTL works with DCC to request that the covenant be extinguished. And it's good management because we've got the other LGFA covenant, net interest to total revenue, which would still apply, which is the better and more accurate measure of our interest expense and relative to revenue as compared to rates income.
Councillor Lund.
Do we have any idea of the cost to make this change? It's identified as a disadvantage. And also, would it not be true that, would it not be more prudent to wait until amalgamation or reorganisation is completed so that we then have a very clear picture of our financial, the combined position going forward?
Yeah, the cost would be legal costs and wouldn't be that large. I would estimate it might be $15,000, something like that, 20,000 maybe, just really legal fees to change documentation. That would be it. No, it'd be very inexpensive, I would have thought.
No further questions, councillors? There being none, thank you for answering all of those questions, Mr Davies and Ms Allen. That's much appreciated. I'd like to move that the committee notes the Local Government Funding Agency Covenant Report and B, approves the approach outlined in the report that Dunedin City Treasury Limited and DCC write to LGFA requesting that they consider extinguishing the net interest to annual rates income covenant. Do I have a seconder for that? Councillor Weatherall. And in moving that, as I just reiterate what Mr Davies just said at the end, it's about good management, and in my words, I've got here getting our own house in order regardless of what happens in the future with amalgamation. And the other covenant is actually more accurate and more relevant, and that's the covenant, the net interest to total revenue, when so much of our debt actually belongs to the companies. So it's not that we're removing any restrictions at all, it's just having the more appropriate and more relevant covenant. Do we have any other speakers? Councillor Weatherall.
Thank you, Deputy Mayor. I think I've got it right in thinking the main driver behind this proposal appears to be about protecting the financial flexibility for council and our controlled organisations to continue borrowing, I hope prudently, for infrastructure and strategic investment in an environment where future rate caps may be introduced. Council is no different from households and businesses. We all need to be careful with debt. We don't have to be scared of debt either. I'm just hoping any new extra debt is spent to support long-term growth. We must resist the temptation to increase any debt for short-term gains, especially through our upcoming deliberations. Good debt can definitely build a city. Bad debt can burden a city. I definitely will be supporting this initiative. Thank you.
Councillor Walker.
Thank you. I'm just supportive of the, thank you to the mover and seconder, and particularly the mover's comments around just the logic that sits behind this in the context of DCTL working with DCC ultimately for better management. And just also, I don't know who commented about amalgamation, but just cautioning all of us that we have to be careful not to get into the mindset of deferring decisions because of amalgamations, because we simply just have to move on in the context of where we sit at the moment.
Councillor Vandervis.
I'm interested that the spectre of good debt and bad debt has been raised again. And mindful of, I think it was Councillor O'Malley who was very keen on the idea of good debt and the flexibility required to raise as much good debt as possible. Light rail to the airport was one of the things that he was keen on doing and thought that would be good debt. I don't agree. The supposedly good management in removing a covenant, creating the financial flexibility is, to my mind, basically another way of making it easier to get more debt in different situations. We have far too much debt as it is. We have so much debt, in fact, that there is very little ability for us to do anything other than keep cranking up rates, because it's only by cranking up rates that we can get our revenue up to a level that meets the requirements for debt. The idea that you can always come under a covenant or a requirement to have a revenue debt ratio basically just encourages spending, as it has done for years now, for much more debt. And then to make that possible, you have to crank up the rates. To me, all of this has led to a situation where we no longer really have any financial headroom. We routinely, and I mean every couple of years for many years now, have to raise our supposedly self-imposed debt ceilings which have been trumpeted as good management, debt ceilings which were supposed to give us headroom, and all you have to do is look at the proposed debt going up to realise that there was never any headroom, and there was never any intention, in fact, to stay within the new ceiling that comes along. The next new ceiling, as I read it, looking at this graph here, and this graph, I'm glad that we got it in a nice big page. This graph basically shows that we have two extraordinary debt monsters currently. We have the DCC $1 billion debt, which for most of the 9-year plan will see us paying $1 million a week in interest. We have the other, very similar actually, companies' debt. And if you see the waterline there, that's $2 billion worth of debt. And we are happily proposing that we are going to continue to exceed that level of debt, over $2 billion. The $1.9 million self-imposed debt limit that has been mentioned today is already well breached, and there's nothing we can do about it. We have become victims of excessive spending, of insufficiently constraining covenants, and of covenants which are expressed in terms of ratios rather than in terms of absolute debt. I don't believe that this particular move is really that significant, because it's one of many similar moves to simply keep pushing up debt and then having to push up rates in order to meet ratio requirements. So I'm not going to vote for this. I don't believe it's good management. I don't believe that we are indulging in much good debt currently, other than the pipes and pumps that we're putting in. I believe most of the transport money that we're spending is bad debt. I believe the cycleways that we're putting in are bad debt. I believe all of that debt is unnecessary, it's unsustainable, and the two debt monsters are going to completely constrain our ability to do anything really positive for Dunedin in the future.
Councillor Hall.
Thank you. It is important to keep some perspective around these ratings. Dunedin, sitting at AA negative, still places us among the strong and credible financial position nationally and internationally. We are operating in an environment where the councils across New Zealand are under pressure from infrastructure costs, growing demand, and reform uncertainty. And many councils have seen outlook downgrades. how are we meant to plan when all these reforms are up in the air? I think we're doing a damn good job. What matters is that we continue to manage debt prudently, maintain compliance, and invest in infrastructure in a sustainable way. Strong Treasury management, long-term financial discipline, and what protects both our borrowing capacity and our ratepayers over time. Thank you.
Councillor Sims.
Thank you, Deputy Mayor Lucas, and it's actually impossible for me to foreshadow on this because I'm still a bit torn between the good points that you made, Chair, and also, I guess, the practical intents of this. So, picking up on what the seconder said, Councillor Weatherall, you could portray this to be the good debt being removed from the calculation in order to rack up more bad debt, and that worries me. The other thing is I quite like, even though it's illogical, and I can understand the arguments we've heard that the current situation is illogical, even though it's illogical, the retention of that good debt burden within our existing covenants, that's then a self-imposed constraint, and I quite like having that self-imposed constraint there, particularly when we've heard that we're in no danger of breaching it at this point. So I am wondering why we're doing it now, but I just am more mindful and very inclined to agree with some of the points that Councillor Vandervis made, that giving ourselves more headroom to spend more money and rack up more debt doesn't feel like the right thing to be doing right at the moment. Thank you. Councillor
Lam.
Following on from that, I agree with Councillor Sims and Councillor Vandervis, and I would note that Standard & Poor's don't have good debt and bad debt, it's just debt. And so to say that there's good and bad debt when it comes to our debt burden and what we're paying for it, it's a fiction. And debt burden is our biggest problem. You know, it's and I do not agree that we should be making ourselves more comfortable with more debt, as Councillor Vandervis has so eloquently put it, and I want guardrails around it. As we've heard today, Mr Davies said that there's actually not a point where this limit is going to be breached in the foreseeable future, so it's not actually that much of an inhibition, but we need to send a strong signal that we're being disciplined about our spending, and I don't believe that we're being disciplined in many areas. And that is the whole intention of the upcoming rates cap, is to discipline council spending, like it or not. And I agree with Councillor Vandervis that it is in fact insufficiently constraining, so I will not be voting for this.
Mayor Sophie.
I will be supporting this. I will put people's attention towards the graph on page 91, and I also, it's interesting to have the debt graph, but I think that on top of that we should also have an asset graph. Assets are forecast in our 10-year plan to grow from, equity from $4.6 billion of assets to $5.6 billion, so to grow $1 billion in our long-term plan. And when we actually look at where the debt is occurring in our long-term plan, in 2025 actual, the council debt is 400 million. In 2034 it is forecast to be 500 million. So currently it's 42% of the debt. It will look at being 20% of the debt in 2034. When we look at the water debt, which is actually one of the key things that we need to be concerned around, currently the water debt at around $300 million is around 20% of our borrowing. In 2034 it's forecast to be around $700 million, around 30% of our borrowing. And then we look at the actual numbers around the debt. Currently we have around $700 million of debt, 50% of our debt with DCHL. In 2034 it's forecast to be $1.2 billion, 50% of our debt. So we're not talking about frivolous council spending, we're actually talking about enabling Dunedin City Holdings, which has the majority of our assets and perhaps a little less of our cash flow, to have that headroom. And I think that at one stage it was mentioned that this is a common sense approach, so I do support the common sense approach. I don't think this is opening floodgates to frivolous borrowing. It's actually enabling us to do a better job within the covenants, and we've been talking about the covenants and the way that they restrict us for quite a long time, or the way that they restrict our companies for quite a long time, and with the rates cap that would be even more restrictive.
Councillor Treadwell.
Tēnā koe, Madam Chair. It's all rather complicated. I sort of concur with Councillor Chambers talking about uncalled debt and the complications there. This is where I think I differ in opinion to Councillor Weatherall about the household nature of a council, in that we don't worry so much about uncalled debt or debenture in my household. Debenture is something I've been reading up on in the past couple of days. Plainly, there's a lot of expertise in this room with regard to business and financial management, certainly around the table. And there's differences of opinion even amongst our, like really very learned colleagues that we have here. What I would suggest is that none of us stack up to Standard & Poor's level of expertise here, and they're also the people who give us our credit rating. And the people who have best predicted and are most aligned with Standard & Poor's knowledge are the excellent people who we have employed or elected here. So similarly to Councillor Sims, I did have trouble considering where I would land on this, but ultimately I think we need to trust in our excellent authorities in this matter, who have really the lifelong experience here. And while the numbers are big, I think their sober assessment is something I trust more than the kind of alarm that might be indicated by the dinosaurs we have seen. So I'll be supporting this motion. Thank you.
Thank you. No further speakers. Councillor Mayhem.
I'd just like to make a comment about good debt in this context. So using capital investment for core water infrastructure, not for day-to-day operating shortfalls. By servicing operating revenues set to cover the cash operating costs, we sustain lender confidence and access to that LGFA financing, keeping the debt within its limits, reducing near-term charges versus pre-funding through higher rates, and then ring-fencing those water services with transparent metrics and sufficient headroom. An in-house model that debt funds renewals while maintaining debt at 250% strategically limits and achieves a positive operating cash ratio and rising FFO coverage over time.
Thank you, councillors. And in my right of reply, I will echo Councillor Treadwell's sentiments in terms of we have professional staff and we have professional directors in this capacity who, they in their day-to-day basis, some of them, are investment bankers, and they have recommended this to us, and they won't have made that recommendation likely to change this covenant. And also in reference to Councillor Lund about guardrails, it's not as if we're removing all covenants. We're removing one, and in light of what Mayor Sophie said, that DCC debt is only 20%, will be only 20% of our debt in 2034. So the rate to interest covenant seems a little bit out of sorts if our debt is only 20% of the total company debt. And as I alluded in my question earlier to Ms. Allen, that when this council agreed to keep Aurora, we knew that we would have to review the covenants to allow Aurora and other companies, and including council, to continue to borrow. And so this is one of the flow-on effects from that decision. So with that, I would like to put the motion. All those in favour? By division? Okay, by division. Thank you.
Mayor Barker?
Aye.
Councillor Chambers?
Aye.
Councillor Gaylor?
No.
Councillor Hall?
Aye.
Councillor Lund?
No.
Councillor Mayhem?
Aye.
Councillor Sims? No. Councillor Treadwell? Aye. Councillor Walker?
Aye.
Councillor Weatherall?
Aye.
Councillor Vandervis?
No.
Councillor Lucas?
Aye.
It's carried 8-4.
Thank you. I think, councillors, we'll just do item 8, then we'll take a break after that, so then Mr Davey doesn't have to keep waiting here. So we'll move on to item 8, Waipori Fund quarter ending 31 March 2026, and I'll invite up Mr Davey and Ms Allen to the table. Thank you for waiting, Mr Davey. The floor is yours. Have you got any opening comments?
Yes, the March quarter was a difficult quarter for the fund, and with obvious geopolitical events caused the fund to decrease in value, but it shortly recovered afterwards to be about 116.5 million at the time of writing, which is where it is currently.
Excellent. Thank you. Any questions, councillors? Councillor Walker.
Thank you. You're being very polite there. It's been a mad time for markets, actually, the last year, even 2 years. I'm just, again, as I've always done, just looking at the pie chart on page 70 with our asset allocation. Just sort of goes back to my earlier question around that critical need for that a review of the SIPO. And if we look at what's happened over those since the initiation of our SIPO, how markets have generally changed, it just speaks to probably the need for that review and for us to critically look at that review when it comes back to make an appropriate decision moving forward.
Yes, very much agree with those comments.
And the intention is the SIPO will be reviewed and adopted by council to be in place by 1 July 2026, is that correct?
That's the plan which is being worked to currently.
Excellent, thank you. Any further questions? Councillor Lund.
Thanks for that update, Mr Davey, about the value of the fund. So in terms of our income, our target, we had a target for the year of 5.3 million. We were well down on that in the report. What is your estimate of where we're going to be sitting for the total income for the year, ended 30th of June?
Difficult to comment on that one just right here, right now, without other numbers in front of me, sorry.
But we are, at the present time, at that report says that we have a surplus of 2.4 million with the 30th of March, and our target's 5.3 million at the 30th of June. So we're probably not going to get there, are we? And the reason I'm asking is that I'm keen to know if there's going to be a distribution this year. There wasn't a distribution last year, and there's no mention of it, but there is a figure that's obscured on the graph, which looks like 2.6 million. So if you could speak to that, that's on page 71.
I can probably help with that, Councillor. We haven't taken a distribution as yet, and obviously we'll probably wait closer to just to see where it's going to land at 30 June before we did take a distribution, because we need to make sure that between now and then it's still inflation proofed and meeting that criteria there. Yep.
But if you can't give us an answer now, it'd be useful to know in the next few days just where we're going to be sitting, relative to our income, because it doesn't look like we're going to get there. We're going to be well off the 5.3 million.
It's probably difficult for staff to answer that, as was alluded in the earlier question. In this turbulent times, there's a lot could happen between now and 30 June. So I think that's put staff in an incredibly difficult position to crystal ball gaze to that position. Any further questions? Oh, Councillor Walker. Not happy. Thank you. Thank you, Councillor Walker, for moving that. I'm happy to second that. Thank you, Mr Davies, for everything today. And thank you for your work in the space. Thank you. Do you wish to speak to it?
Yeah, I just will briefly, I hope. I'm always happy to move this report, and it is important to point out here two things. I mean, if we could predict what markets were doing, all of us wouldn't be sitting around this table. If we predicted 10 years ago to buy Nvidia stock, you'd be sitting on an island somewhere in the Caribbean. I think it really is important, though. I've been around this table a long time. It has always perplexed me looking at, if you go to the pie chart, seeing 40% of that fund sitting just in fixed interest. And I know every portfolio needs a balance. And I'm also always perplexed that we have such a high weighting in NZ equities, and to a lesser extent Australia. For those who do follow the markets, the NZ the NZX has been one of the worst performing markets over the last 5 years. And if you look internationally, there's been markets where there has been extensive growth. So I just think hopefully when the SIPO spits out the review, it will give us the option of being a little bit more willing to be able to give a bit more leverage to have that money working more favourably for us and ultimately the ratepayer.
Councillor Hall.
Thank you. I'd caution against any moving the dial up risk based on 1 quarter. The recent underperformance came in a risk-off environment where equities lagged. The fund is deliberately diverse to balance income and capital, not to win every quarter. The disciplined approach is to stick to the mandate, monitor the performance against objectives, and make changes only through the normal review process, not impulsive. This is how we protect long-term outcomes and avoid pro-cyclical mistakes.
Any further speakers? Do you want right of reply to Councillor Walker?
I will briefly. I can't let that one go with my good friend Councillor Hall, who has just spoken very sensibly, which is opposed to his personal views on investing. But I guess we can happily separate those.
With that, I'll put the motion. All those in favour, please say aye.
Aye.
Against? Motion carried. Councillors, I suggest that we adjourn until 11 o'clock. Seconded, Councillor Walker. All those in favour, please say aye. Against? Motion carried. So we'll adjourn till 11 o'clock. Thank you.
Sorry, Doug, couldn't resist. The man who throws his money at SpaceX.
I would like to move on to item number 10, financial strategy compliance. I'd like to invite Ms. Allen, our Chief Financial Officer, and Mr. Tony Nellams, our Project Accountant, to answer, have any opening comments and answer any questions. Have you got any prefacing comments, please?
Thank you, Deputy Mayor. This report obviously will need to be updated as we adopt our annual plan and as we get the next lot of statement of intents as well. So it's reflecting the 9-year plan still at the moment and last year's statement of intents. And we will start reviewing this as we work towards the next 10-year plan very shortly.
So it's a good background for councillors to get up to speed with the strategy because it will come back for review.
It'll come back, yes.
Thank you. Do we have any questions, councillors? No. Oh yes, Councillor Vandervis.
If we look at page 92 going on to 93, it says 2025-26 statements of intent DCHL and its subsidiary associated companies. The council increased the level of DCHL uncalled capital from 1.6 billion to 1.9 billion. When is it anticipated, given the dinosaur debt monsters that we have a graph of, when is it anticipated that we're going to have to push that up again?
Thank you, Councillor. We've indicated that we would normally be doing this on a 3-year cycle. With that, well, we were obviously out of cycle with the 9-year plan, but every 3 years as we do a 10-year plan. But we'll be monitoring it, and if the statement of intents or our annual budgets meant that we needed to review it more regularly than that, then we would. So at the moment, we're forecast to review it next July.
Thank you.
Councillor Lund.
Ms Allen, at page 93, we talk about the council debt limit, and it says that that the council's self-imposed limit is 250% of revenue, but we just heard from yourself and Mr Davey that Standard & Poor's see that limit as the tipping point going from Category 4 to Category 5, the lowest possible rating, which would be the red zone. Is there some concern about that? Should we be looking to reduce that 250%?
Thank you, Councillor. As we work on the next 10-year plan, we'll be reviewing all of these limits again and taking that into consideration.
Any further questions, councillors? No, thank you both for that. There being no questions, I would like to move that the committee notes the financial strategy compliance report, seconded to Councillor Vandervis. Does anybody wish to speak to it? No, as I said, my question to Ms Allen, this is good background reading and understanding, as we'll have to review this and align with lots of other documentation, so it's good to get an understanding now ahead of the long-term plan that is coming up over the next 12 months. So with that, I will put the motion. All those in favour, please say aye. Aye. Against? Motion carried. Item number 11, debt repayment policy. I'll invite Ms Allen and Mr Nellams back to the table. And I have to say, I'm very excited to see this on the agenda. So thank you I know this has taken a lot of work. So, and Mr McAuliffe, thank you. Opening comments.
Thank you, Deputy Mayor. This is our first draft of the debt repayment policy. And what we hope to do is answer any questions today and then have a session where we can discuss this in a workshop to gather feedback. I'd just like to stress that this is how we manage the debt that we have, as opposed to it being setting debt limits or anything like that. But happy to take questions.
Miss Sophie.
I remember having a conversation with Deputy Mayor Lucas about, I found a 2010 annual report, and it did actually have basically a report about this allocating debt to projects. And is this I won't say back to the future, but is this basically that is around allocating debt to projects and then having a policy about the repayment so we can see them a lot more clearly?
Thank you, Mayor Sophie. To be honest, that's not where we've based it on. I wasn't privy to that history, so it's probably some useful reading for me to reflect on further. But yeah, the intent is really just to get a bit more transparency and a bit more detail around how we're actually allocating that debt. Thank you.
Councillor Lund.
Ms Allen, will we have, in terms of page 108, it talks about legacy debt, and that's what I'm most interested in. Do we have a definition? Can we be clear on what we mean by legacy debt? That's my first question, but I'll let you answer that.
Thank you, Councillor Lund. Yeah, to be fair, that's probably one we can tighten up a little bit more. There is a definition in there, and it's just kind of pointing it back to some, historic debt. But at a high level, the way I think of it is it's that kind of pre-existing debt. Yeah.
And just in terms of the stadium at page, it's talked about how, and I've mentioned this before, that with its capital renewal program and maintenance, there is a potential to extend the life of the stadium, which obviously has our $86 million of legacy debt attached to it. So can we give consideration to not, because at the moment the stadium's life is estimated at finishing at 2060, a 50-year life. It would have significant effect if we could extend the life of that stadium. Can we look at that?
Thank you, Councillor Lund. We can take those comments back to DSPL.
And if I could just ask a follow-up question about the legacy debt, because I see there under 10.3 it talks about how repayment may occur, but in practical terms, in our current environment, it's not going to be hardly ever repaid. So within this policy, we really don't have a clear strategy of how we're going to repay the debt.
That's correct, and we need money to repay the debt, but obviously we're looking at having this life cycle, and because we're in a borrowing situation, we're only borrowing at the moment, but we might need to look at cycling off some of the old debt and borrowing more for the new.
Yeah. No, thank you. Councillor Vandervis.
Getting back to the legacy debt definition, you've mentioned pre-existing debt. Does pre-existing debt include budgeted debt, as in the graph that I've shown earlier? Is that essentially pre-existing? Is pre-existing basically what we are already budgeted for and essentially obliged to?
Thank you, Councillor. This is looking at actual debt, so that the debt that we have on our books at the moment.
So anything prior to the current date is what you call legacy debt?
That's correct.
And the assumption is that the future debt that we're committed to and that we're budgeted for is not legacy debt.
Yes, and this is for us to, as I said, it's how we manage the debt that we have as opposed to what we're forecast to have.
Okay, thank you. If I go to page 101, there's E there, the promotion of intergenerational equity as a long-term financial prudence. The intergenerational equity argument is used throughout this paper, and its characterisation as long-term financial prudence concerns me because if you look at the history of Dunedin, and especially at that graph, you realise that before 2003 we had billions of dollars worth of assets and no associated DCC debt, no intergenerational debt. How then, after 100 years of developing Dunedin without intergenerational debt, how does now billion-dollar debt become financial prudence?
Thank you, Councillor. We're not meaning to tag those two concepts together like that. One is one of the reasons we have debt is for intergenerational equity. One of the purposes of doing this policy is for long-term financial prudence, because we don't have a policy at the moment for managing our debt. It is actually just literally sitting there.
So, can I put it another way? Why is it that in the future now we are going to debt fund basically everything and argue that it's intergenerational equity, when in the past, for the majority of the time of the development of Dunedin, we didn't saddle future generations with debt at all? Why is it that we're doing it now and calling it financially prudent?
Do you want me to try?
Please.
Well, I think, Councillor, things have changed as well, right? And we are now doing far more than we used to do, that reflects ageing assets. So things we built 100 years ago, if we didn't actually maintain them, now all come to needing maintenance at the same time. So partly there was a lack of investment historically in assets that has caught up on us. So that's a factor. That we're doing it all from debt's not true, I don't think. I think there's a good amount of it, mostly the depreciation, and Karen will check, but our renewals program is done from cash, that broadly, yeah?
Well, yes, we do have our depreciation funding and NZTA funding as well. So it isn't, the capital program isn't funded 100% debt. In fact, in the draft budgets that are coming next week, it's less than 50%.
And that's the balance that we have to find to be prudent between funding, using cash for renewals of assets we have, but then looking at how we debt fund other assets. And I think what you should focus on, and I get we need to learn from the lessons of the past, but this is about how we set the city and the maintenance of our assets and our capital base up for the future. And we can't change what was done in the past. And you can look, and I don't want to name names because Grant will report it, but you can look to some of the issues that we have had historically with underinvestment and what that caused.
If I could add to that, this policy isn't about the spending decisions either. It is about the debt that we have and then how we manage that and report on it. Yep.
Thank you. Councillor Sims.
Thank you, Deputy Mayor Lucas, and thank you for putting this paper in front. And I think probably some assurance from the intent here, but I just want to be really sure. So going forwards, if we built a rubbish dump, for instance, would the interest on the borrowing required to build that asset become a top line expense of that department as opposed to being funded from the consolidated fund? Is that part of the intention here?
Yes, but we do that already, so we don't have just a consolidated fund. We are ensuring that when we borrow, it's for the assets that we spent the money on.
So going forward, the budget for that department will alter.
Yes, sorry to cut you off there, Councillor. Yes, it will. It will include the budget for the interest. Yep.
Councillor Lund.
Ms Allen, do you think we can have a policy that can differentiate between different councils? So if we amalgamate with other councils and they're in a far worse position from us, and for example, if we had, say, a bumper year with DCHL in the future and we got $50 million of dividend and we decided to pay back $30 million, do you think can we have this policy so that it can be clear that that's for the benefit of Dunedin residents and not the benefit of the other councils, that have not had no part or benefit of that? Is that going to be overly complex?
Look, Councillor Lund, any questions about how any possible amalgamated structures are set up are very premature, and there are a raft of work streams that would be required to look at if we were amalgamating or forming a unitary authority. So it's far too early to say what that would look like. All councils will come with things that they want to protect, potentially in their own local area. So it'll be a negotiation as part of any work around amalgamation.
So this might be a very short-lived policy, is what you're saying?
Not at all. No, not at all. Because at this stage there is no formal amalgamation plan on the table. But it depends on where things land in the next 3 months for this council and where the government lands in 2028.
Well, it would appear. Well, I think we can all assume that there is going to be some, unless there's something you're not telling us, CEO Graham.
I tell you everything, Councillor Lund.
Any further questions, councillors? Sorry, Councillor Sims.
Sorry, no, and I do kind of remember this from the outside, but your paper reports on a council resolution from the 26th of May 2025, and I remember probably the community and the media being quite alarmed at the time that the council appeared to sort of give itself the ability to fund operating expense with debt rather than just capital expense. I wondered but it's a very specific resolution, and I wondered what the intent of that resolution was and whether that continues to provide any risk for the council.
Thank you, Councillor. The policy always had the ability, and it still does, to borrow for operational costs. So in the event of when we had COVID times, for instance, and we lost a lot of our revenue sources, we actually needed to borrow to balance the books. But the intent there was for the grants for the performing arts sector, and we did a research. This had occurred in Clutha District Council, and there might have been one up north as well, and this is how the funding had been arranged.
The background was that council decided they want to signal that they were prepared to look to fund the 3 performing arts facilities in varying degrees, but didn't want to have to necessarily pay cash for it and increase the rate significantly, and the mechanism already existed to do it, but it's a very bespoke and I would suggest one-off situation. Apart from COVID times, I am very clear in terms of our management of council finances that we do not borrow to fund operations.
Sorry, and you're sufficiently confident that that motion is robust enough to prevent us borrowing money to pay for the groceries?
Well, I am, but that is always at the will of council. You can always, as you know, because council is in the governance structure, if you said we want you to borrow to pay for the groceries rather than increase rates, then or buy fewer groceries, that's your call.
And I think it's covered in their debt and financing policy as well. I'm looking at Mr. McAuliffe, isn't it included in their other policies?
The revenue and financing
policy, yes. Yeah. Yes. Thank you. It's an existing policy that's already in place. Councillor Vandervis.
On page 99, there's this rather long and convoluted sentence, which I'll read from the start. It says, debt may be used to fund operating expenditure where it is providing a one-off grant to external community organisation that is constructing or upgrading a building, such as a community facility that provides enduring economic and wider community benefits. It was said earlier that this is an attempt to be transparent. To me, this is one of the more opaque sentences I've read in a very long time. Does this mean funding curtains for the stadium?
No, I think CEO Graham just explained that.
This was a really specific resolution, if you remember, Councillor, from the annual plan last year?
Long-term plan.
9-year plan.
9-year plan.
Related to this council's or the previous councils wish to find a way to fund the various theatre proposals, and that's what this was designed to do.
So is that basically still on the books? Is that still something that we are looking to use debt for?
The policy, the revenue and financing policy was amended with those amendments. That's right, isn't it, Carolyn? And that is still the current policy, but subject to full review as part of the upcoming 10-year plan process.
Yes.
So that's all good, but just to finalise it, does an external community organisation that is constructing or upgrading a building, could that be our companies doing something with the stadium?
No, they're not an external community organisation.
And Councillor Vandervis, you will have the opportunity to review this as part of when we review the revenue and financing policy as part of the long-term plan. Are there any further questions? Thank you for answering those questions, and I would like to move that we note the draft debt repayment policy, and Councillor Wetherill had indicated that he would like to second that, and as I said at the opening of this item, I am delighted to finally have even its draft debt repayment policy. When I got on council, I was shocked actually that we didn't actually have one, and I know talking to staff that we are now, there are very few councils, if any, that actually have a debt repayment policy. So I would like to absolutely congratulate the staff. It's been quite a big task, and I think this is the first step on the journey. As was indicated in the report, there'll be a workshop to discuss this further, and we can tease this out, but I think it's definitely a first step in terms of developing our repayment policy. So I'd like to congratulate staff. Thank you. Councillor Vandervis.
I'd like to similarly. I am absolutely delighted that we finally have this policy. Also surprised that very few other councils have one, especially if you look at the state of a lot of other councils' debt. The workshops that we are going to have hopefully will clarify a number of things, including the date, for instance, that the repayment policy would be presented to council, the date of the future finance and CCO meeting where Ernst & Young implementation plan would be presented, and I'm particularly interested in what kind of implementation plan there might be on account of when it says here on the top of page 101, provide a pathway to repay legacy debt, preventing debt balances from rolling forward indefinitely. This has been the fundamental problem, as I see it, for a very long time. And the question really is, how is it going to be possible to stop these debt balances from rolling forward indefinitely? So I very much look forward to the further development of this debt repayment policy. I have struggled for years now to get people to even consider the idea that we might repay debt. All we've ever done for 20 years now basically is rack it up, and rack it up much more regularly every 2 or 3 years for the last decade. So I'm very keen to see this debt repayment policy being further developed, and for an awareness of what we are going to have to do in terms of reeling in spending and in terms of reeling in operational costs. And by that I mean staff costs, if we are to be able to have a possible path to repay legacy debt. Thank you.
Councillor Wetherill.
Thank you, Deputy Mayor Lucas. Hallelujah. Finally, we are putting a framework around debt repayments instead of simply kicking the can down the road and sticking our heads in the sand. I would like to say a huge thank you to Deputy Mayor Lucas and the former late Mayor Jules Raddick for moving to amend the revenue and debt repayment policy in the last triennium. I support this policy because it introduces some very simple but very important principles. Debt should have a life cycle. Borrowing should match the life of the asset and future generations should not inherit endless rolling debt with no clear repayment plan. Let's be honest, debt can absolutely be our friend when it's used for long life infrastructure that strengthens our city for decades to come. And yes, Councillor Sims, Smooth Hill does come to mind. Water, roads, resilience and core infrastructure are investments and are not reckless spending. We also cannot ignore the risky financial environment we are operating in. Economic uncertainty remains high, and ratepayers rightly expect discipline from all of us as governors. I love the clear message that this policy sends, that yes, we are still prepared to invest in Dunedin's future, but most importantly, if supported, we are also prepared to take debt management and repayment seriously, at long last. Thank you very much.
Thank you. Councillor Chambers.
Yeah, thanks. Yeah, I think that being able to develop a debt repayment policy is a very positive step. But I'd just like to comment on Councillor Van der Vis mentioning that intergenerational debt was perhaps a new thing. And I don't think that really squares with the history of Dunedin. If you go back 100 years, I think the debt to income ratio of the council in the 1920s was much higher than it is now. But the debt that the city had from the early part of the 20th century was paid off by the 60s, 70s, partly because New Zealand was one of the wealthiest countries in the world between the end of the Second World War and the 1970s. Perhaps if it wasn't so wealthy, we would still be paying the debt for the building of streets and pipes in the 1920s. So I think here we are again at a time where our infrastructure is being replaced and we're getting into debt. But I don't. The fact that it takes more than one generation of ratepayers to pay off debt has always been the case, I think.
Are there any more speakers? Ms. Sophie.
I just want to comment that Deputy Mayor Lucas and I did have a conversation when I was looking through some of the old annual reports, and in one of the annual reports it was, I guess, delighted to see that there was debt that was allocated to the actual thing that it was being. Sorry, I'm like trying to think about the pictures that I saw, that the debt was actually allocated to the department or the project, and I think that was something that is perhaps changed a little bit more, and then the repayment sort of happened to be consolidated in the perhaps never, but it's nice to see that this policy will help affect that. One of the challenges here is making sure that we have a debt repayment, that the debt is allocated and repaid in a manner that reflects the economic life of the assets being funded. And I think when we went back to the 210 report, there was still some stuff in there that hadn't been repaid, and I think also that this will focus our concentration when we come to our LTP about the pathway to repay that legacy debt as well, that I think is really important, because it has all been consolidated, and that means that we don't have clear vision and focus on around the debt, what we're paying back, what we're not paying back.
Councillor Lund.
I support this policy, but I would urge a note of caution. If we look at section 10.3, it talks about the question of where does the money come from. And, in item D, it says that council would be in a net debt reduction position, but really there's only really two ways that we can get funding for debt reduction that doesn't affect ratepayers, and that is dividends from our holding companies or from the sale of assets. So I just want to make a note of caution that yes, it's great we've got this policy, but we've got to firstly focus on where is the money come from, and that should not be coming from rate rises.
Thank you. Any further any comments? With that, I'll put the motion. All those in favour, please say aye.
Aye.
Against? Motion carried. Thank you. Move to item 12, financial report for the period ended 31st of March 2026, and ask Mr McAuliffe and Ms Allen to come to the table, please. Thank you. Do you have any opening comments?
Thank you, Deputy Mayor. Happy to go to questions.
Thank you. Councillor Van der Vis.
happy to see on page 118 the annual capital year-to-date expenditure being well below what was budgeted. And we've heard earlier today of some of the advantages that gives us financially. Is that expected to continue for the remainder of the period?
Thank you, Councillor. Yeah, we still expect the capital forecast to be around that $170 million mark. We're still progressing through our April results at the moment, and the forecast is still within that envelope.
So is that roughly kind of 30% below what was budgeted? I had that figure quite some time ago. I'm wondering if it's still that low.
Our current capital expenditure is 30% below year-to-date budget. Our budget for the full year was $231 million, and $177 million is the revised forecast. So about 75%. So again, 25% under the full year.
And if I can ask kind of a flow-on question from that, so does that mean our borrowing will only be 75% of forecast? I mean, I know we only borrow roughly half of our capex. I'm just wondering, what's the flow-on effect for our borrowing?
Correct. So we will have a lower opening debt balance rolling into the next year than what we expected. I think we expected to be ending the year 80 million. We're projecting that's going to be around about 720 million to open for the next financial year. So yes, it does have that flow-on effect.
That's good, thank you. Yes, Sophie.
So in looking at the capital expenditure, I see that there's around $6 million in project cost savings, which is fantastic on some of those capital things. But I'm also just concerned that about our delivery for our community. We've got a whole lot of projects here that we're not delivering on, and I certainly understand the waste minimisation. We've had many questions about the preloading here, but we've also got timing delays for the Dunedin City Library refurbishment, upgrades and renewals on the Sims building, the railway station, roof renewal projects, Ulverston upgrade, Parks and Recreation, timing delays in the Moana Pool redevelopment project, timing delays in some transport projects. So these projects are still to be carried out, and they would be carried out in the next financial year. So these capital expenditures are, am I correct in saying these capital expenditures are just project delays, and they'll be happening in the next financial year?
Thank you, Ms. Sophie. Yes, that's correct. So we'll be bringing the budget reports next week to Council, and that includes a schedule of, I guess, budget shifts or carry forwards of work that will be completed in the following year.
But there will be, Councillors, an opportunity for you to pause work that you don't want to do as part of that as well. So that's part of finding that balance between what the acceptable level of capital delivery is for your community, and then the acceptable level of borrowing. So, but we've just been reviewing the capital report that will be coming out today for the annual plan deliberations.
Mr. Ward or Ms. Nielsen, did you have a comment or?
I'll hand over to Ms. Nielsen, who may want to add to my comments. Thank you for the opportunity, Deputy Mayor Lucas. I think it's also a question of trade-offs. You know, we put our assertions forward in terms of what needs to be taken forward in terms of the contents of the capital programme, but there are trade-offs, particularly in terms of timing. Does that work need to be done now? Can it be deferred till later? What are the consequences of deferring? So these are things that we're juggling with all the time in terms of prioritising the work, what's important to do, what's necessary from a compliance perspective, functioning, whether it's this building or other civic buildings. So these are things we're grappling with all the time, and this is where it is helpful to have your direction in terms of what you see as a priority for the council functioning and for the communities, and then you see that manifest itself in the capital programme. Central Library, for example, you know, there's a plan for ongoing renewals. Does that need to be done now, and particularly in the way that we had first contemplated? Is that something we can reevaluate? So that's just an example of the trade-offs that we're undertaking all the time.
Thank you. Yeah.
just want to follow up on that because I don't think that we'd signalled to the public when we went out for consultation that we might delay some capital projects that might be important to the community. So if we're looking at our annual plan, how do we consult with our community around any of these priority projects and delays in them?
None of them will trigger significance to a point that requires specific consultation on those projects. And you'll see the things, and we literally were just reviewing the draft in the during the debate on the last item. It's still a reasonably sizable capital program that you will be presented with in your papers that go out tonight, but with one or two decisions for you to make around delays or deferrals specifically, or whether or not you want to look at doing some things following consultation on as part of the 10-year plan process.
Councillor Lund.
I take it it's appropriate to talk about CapEx by activity. Yep. So this is a question for Ms Nielsen. I see that we've radically underspent our budget on the Edgar Centre, which I'm heartened about. Can I ask the question if we have now a scope of work for the Edgar Centre re-roofing, or is that still to be determined? First question.
Good. Thanks for your patience there. We are almost there with options for the Edgar Centre re-roof. Our intention is to come to Council in June or July with those options so that you can give us direction.
Thanks. And in relation to the municipal chambers, we've spent 1.35 million this year. Can I assume that that's virtually all exterior restoration and there's been no seismic work done this year?
The physical works have been focused on the exterior heritage restoration, that's right. The seismic program of work has been focused on the detailed seismic assessment and complementary occupancy assessment, so technical rather than physical.
In terms of our major buildings, have all of them been assessed for whether they're earthquake prone?
No.
Could you give us some guidance about how many buildings, is it half, or do we have still major facilities that have not been assessed?
Oh, I'm sorry, I don't have that level of detail with me, Councillor.
Would it be fair to say, Ms Nielsen, there would be still a significant number?
I think it depends on what you class as a significant building as well. Like we own sheds, for example, on parks all over the city. I don't know if you mean those. Water treatment plants. So it depends on what you mean by significant buildings.
I mean things that are not light frame timber construction, things that might potentially be earthquake prone. That are yeah, not minor. But anyway, I'm happy to get some advice after subsequent to the meeting. Can I ask one other thing regarding Ms Nielsen? Can we make the lift replacement in this building the highest priority, because it's embarrassing that we have a council facility that has a lift that doesn't work a lot of the time, and as far as I can see that there's no funding for that. I may be wrong, but I couldn't find any. Can you please give us some guidance on that?
Let me ask Anna, is there funding to replace the lift in this building?
We have a lift replacement or lift renewals program that is funded through the long-term plan. We're going to review the prioritisation of those lifts literally in the next few months. We're aware of some of the issues that are happening with the lift here and a number of other key lifts in the city, so we just need to get that prioritisation right.
Councillor Chambers.
Yeah, thanks. Just with regard to page 132 about roading and footpaths, about footpath renewals and pavement renewals. So the pavement renewals are overspent by $2.4 million, but the footpath renewals are underspent by $4.3 million, which is considerable. If I could ask you a naive question, what's the difference between a pavement and a footpath? And secondly, is this some sort of policy change to concentrate on pavements rather than footpaths?
Thanks, Councillor. Second question first. No, there hasn't been a policy change. The pavement refers to road. footpaths are footpaths. So, we didn't award the footpath contract the beginning of the last financial year. We revised the outcomes we wanted from that and went back out to market. So that's very close to award now. So we've redirected some of that budget into roading renewals. So that's where you'll see a decrease in footpath and an increase in pavement or road renewals. I guess the silver lining for doing that is the funding assistance rate that we get from NZTA is much, much higher for pavement, for roads, than it is for footpaths. I think it's 9% for footpaths, I'm looking at Carolyn, and 51 for pavement. So, but yeah, that's so no policy change. It's just an operational shift, and that'll be picked up again when we award the contract to start 1 July.
If I can ask a question, it's almost a follow-up question, and a number of members of the community have commented to me in the recent weeks of the huge number of activity that's going on in our streets, whether that be, I mean, some of it's Aurora, I understand that, some of it's water and some of it's roading, and the perception is that we're trying to madly spend our budget. I'm just quoting, and also when they look at when they go past the contractors, a number of them have got higher equipment, and it's like. And that kind of feeds into that story, is that we're madly spending their budget and the contractors didn't know this work was coming, along with another narrative that we've put out is that we're now not in the season of doing roadworks once we get into winter. So I'm just wondering whether maybe Mr. McLean, you might make some comment on that.
Thank you, Deputy Mayor. No, we're not madly scrambling to try and spend our budget. We report through regularly to Council on the progress of our capital spend. There are a lot of infrastructure upgrades going on in the city at the moment, and as you mentioned, some of them are related to DCC and some of them are related to other utilities companies. So, but it's all part of what we've budgeted for and what we've planned for. So, but it's not unusual for contracting companies to hire equipment to carry out jobs.
Okay, it's good to hear, and I mean, infrastructure upgrade is obviously good for the city, which I've told people is that it's going to be a better city once it's gone through. Councillor Lunn, did you have another question?
I've got three quite quick questions. First one relates to Bath Street. It's paid 132. It seems to be a very severe budget overrun. We've spent 1.93 million and the budget was 900,000. It's more than double, and I know that we've already made scope reductions. So can we please have an explanation about why we didn't revisit the scope of this work even further to try and save $1 million? And to be honest, the feedback I've had from building owners in Bath Street is that the work is quite underwhelming. So that's the first question. Should I
just pause there, and staff will answer that.
So the budget last trinium, we briefed the council on where we were at with Bath Street and explained that there would be an overrun, and council agreed to proceed on that basis. The second one is I've actually had feedback from one of the major landlords in Dunedin, including in Bath Street, and he said, I'll reluctantly tell you it looks really good. But council decided on a moderate level of investment. So that was your colleagues last triennium decided that they would set the budget to a moderate level.
Thank you. Secondly, there's an item called the Crown Resilience Program, and it's got $750,000 in it, and we've only spent, I think, 250. Will we lose that funding if we haven't spent it this financial year?
Thanks, Councillor. No, we won't. It's a program through to 2027. The works that the expenditure's not reflected there, but the works that have taken place with the Geo Blocks, Eco Reef it's called, down Tyremouth Road. So those ones that are installed at the moment, that comes out of the Crown Resilience funding, and there's some further work. I think Mr Weir, when the boards came to present, showed a couple of photos of the Eco Reef and some rock buttressing that's about to take place on the Tyremouth Road as well. So that's entirely funded from that Crown money. So it's there till the end of 2027.
lastly, would it be possible to get a breakdown of the nearly $1 million we've spent on playground renewals? I appreciate you won't have that detail at hand.
Yes, certainly we'll get that.
Councillor Galen. Microphone. Just wait while there's blue light flashing, and then and then try again. You up?
Use this one. Yeah, just wondering about a couple of things that have been raised during the meeting. The municipal chambers, do we have a time frame and a longer schedule of works for that building?
So there's funding, there's funding in the draft long-term plan for the seismic strengthening of the Town Hall Glenroy, and then the municipal chambers itself is a more complex situation, so we'll be coming to council with options as part of the long-term plan.
Yeah, I'm just wondering, is that fast enough?
It's a long-term plan decision, so it has to be considered in that context. Sorry.
My other question is just about the footpaths, and I'm just wondering why there's seems to be a lot of footpaths that haven't had a lot of work on them done for a long time, and during the campaign people sent me photos and so forth. So when you talk about reletting the contract, how long has it been since work has not been done in this area?
It's probably under 12 months, I would suspect. What I can say, and it's well documented and well known, is that there was underinvestment in the transport network for a long time, and the council, maybe last triennium or the one before, decided to increase the renewals program to catch up essentially, and so that's well under.
Yeah, just we're coming into winter now, so it would probably pose a bit of a safety risk for some people. So, just I'm wondering how long it'll be before that work gets done.
If you have any specific area in mind, then send it through, and we'll get the team to look at it.
But the new contract will be awarded in 1 July. But remember, it goes nowhere near enough to do the whole network at the same time. So there has to be a prioritisation exercise based on the state of the respective assets. And given the underinvestment for many, many years and the lack of co-funding, so the FAR rate for footpaths is so low that it's basically council funded. So there's a bit of a trade-off as well about how much council is prepared to spend. That again, if you wish to increase your spend on footpaths, is a 10-year plan decision, because there will have to be a trade-off somewhere else in the budget.
Councillor Simms.
Thank you, Chair. I just had two questions. One might be a composite question, Mr Ward and Mr McLean, but there was some anxiety around the table earlier that the underspend on capital delivery would bite us because there was very significant escalations in the cost of getting stuff done. Would it be your feeling now that perhaps that danger has passed and that it might even be cheaper to get stuff done in the near future than it has been?
I'll start. Thank you for that question, Councillor Simms. I'll start, and maybe Mr McLean may wish to add something. It's really hard to predict the outcome of that commercial situation going forward. And I think what serves us well is something I've said before. We have these multi-year programs in place, so that allows us to pivot, to shift where the priorities may emerge to be more pressing. In terms of the cost of delivery, we are, and led by our procurement team under Mr Coleman's stewardship, we're forever having value-based conversations with our delivery partners. And again, that's another testimony to why we have partnership arrangements, so that we can extract value, but not just in a macro sense, how it plays out on particular projects. That's a broad answer, I do accept. But these are things that we challenge ourselves on, and we challenge our delivery partners to be ever mindful of. At the same time, we do see rising costs like fuel. And so there's what's our position on that from a partnership perspective? How do we balance those needs?
Councillor Treadwell.
Tēnā koe, Madam Chair. I have a couple of questions on page 123 with regards to the basically tallying of spend on the October 2024 rain event and the 2025 wind event. I suspect these are Mr. McLean questions. I could be wrong. Firstly, do we think the capital expenditure to date for the rain event will be the end of the capital expenditure for that event?
I'll have to double check with the transport team. I believe that some of the slips work is not quite gets underway, but it's not complete. So there will still be costs attributed to the October 24 event.
Okay, that's good to know. I really appreciate seeing this in here because I think it's important to track. Second question, if I may, is on the NZTA subsidy received. Is receiving a subsidy of that quantity what we can expect for these kind of events consistently?
It's a little bit difficult to say, but they revised their emergency response subsidy. It's not an exact name of it, and we were the first applicants to that. That was changed shortly before the October, so the team did a really great job of documenting as much as they could and getting it through to get that. The level of subsidy depends on the level of damages incurred in terms of the value of the damages incurred, and there are a range of other criteria. So probably be similar comparatively to the size of the event.
Right, so if it's similar comparatively to the size of the event, do you think, this might be too tricky a question, but proportionally it might be similar to the cost that we have to pay?
Or I would check that. We pay a lot of costs that are not subsidised. So the cost to council in terms of our outgoings versus what NZTA provide are entirely different, because of course NZTA will only deal with the roading network, but there's damages all over parks, there's potentially damage to Three Waters assets, other property related things, so the cost to DCC will be larger. Yeah.
Appreciate that. Just one more if I may. With regard to the wind event, just clarification that this doesn't capture any of the loss to any of our DCHL companies. This is just direct intervention from DCC and wouldn't address like lost profit in DCC forests or Dunedin forests. Yeah.
That's correct.
Awesome, appreciate that.
Councillor Lund.
This is a question for Ms Graham. This quarter, the council signed one of its probably largest contracts in its history, a $145 million 10-year water services contract. Council, it was done under delegated authority, I understand that, but that always wasn't the case. I can remember in 2012, and Councillor Vandervis will confirm this, that items of significant capital expenditure used to come before council. I know this because I built stage 4 of the Torty Museum and it went before council, and I would like to know what policy would need to be amended to bring back items of significant capital expenditure to council, because there are things that I believe are governance issues around should we have signed up to a 10-year contract, and maybe we should have, but I believe that it is council's decision. So can I advise what policy would have to be changed?
My delegations.
Would you have discretion at any time to put this to council?
And we have at times put things to council, but this wasn't something. This was, despite what you're saying, wasn't. We've had bigger contracts, and this was a purely operational matter. And as I've responded to you, went through a particularly robust year-long process that got intense scrutiny, and the strategic benefit. And councillors had been briefed that this work was underway, but it was started in the previous triennium.
I understand that, and I'm sure the work was thorough and well done, but we are the council. We've just spent 145 million.
No, you haven't. Well, not necessarily. The terms of the contract are such that there are all sorts of provisions in it that don't necessarily mean that, but at the same time, you're also a council that is competing in in an environment where getting good quality contractors to deliver your water work program, and that is clearly a priority for this council, needs to be shored up in what will be a really competitive environment. So this was prudent, it's sensible, and really good value for money.
I don't think in my view, I don't think the process would have been extended unduly had we simply had a paper, spent an hour debating it, and no doubt accepted the council's recommendation. But we would have known and be able to report back to our ratepayers that yes, in fact, this didn't just fly under the radar and we knew nothing about it.
And I'm not going to let that go untested. It didn't fly under the radar, and council was aware. You had approved a budget and staff committed it in line with delegations and entirely appropriately.
Councillor Galen.
Just looking at the stormwater, the water side of things, can't quite see a mention in there about the South Dunedin situation, and just wondering if I could have that clarified for me, where in fact those renewals sit within this report on page 121.
Thanks for the question, Councillor Gala, and with your permission, Deputy Mayor Lucas, I may bring in my colleague, Mr. Vaiatupu, who's currently standing in for Mr. McAndrew, who's on annual leave. I would tend to refer to the tabular summaries, if I may please, Councillor Gala. That might shed some light on this. We have a number of lines in the activity report that cover the work in either South Dunedin or more broadly across the city on the topic of stormwater. What that will reflect, and sorry I can't get to the page, as on 133, thank you. What that's showing is that we're advancing work in terms of the technical assessments, the modelling work that supports the South Dunedin future. I have previously reported that we've advanced work on the wastewater system. We've undertaken a series of measures to improve the resilience of the wastewater system. But also covered in the report is as directed by Council, the advancement of the 3 short-term stormwater solutions. That's slower than we had anticipated, in so much as that's physical works. Before the physical works can be progressed, we need to understand what assets are in the way and what needs to be moved out of the way, and how vulnerable are they to that advanced work component. But that's nonetheless, the works are progressing. So there's a slight delay in the physical side of things, but there's also an acceleration, offsetting acceleration in terms of the advancement of the analysis and the modelling.
Would it be possible, when we do have these reports, that we have a section specifically around that rather large project in South Dunedin, please, just so that people out there can see what transparently what you're doing for them?
I note the request. I would add, if I may, please, that there's a number of high priority work that we're undertaking. So to try and tailor something just for a particular community might be at odds with what we're doing across the city and the region. But that's obviously something for council to determine and directors to do. But I would just, not wishing to be disrespectful, there's a number of priority works that we're undertaking, and then the tailoring. You may end up back to where you started with a very similar report.
As Mr Ward noted, on the top of page 133, there are 2 line items specifically called South Dunedin. One's called South Dunedin Flood Alleviation, and one's called South Dunedin Short-Term Option. So, and they're in the Stormwater New Capital section. So there are already 2 specific line items.
So we are proceeding with those 3 short-term options. Is that correct?
Are there any further?
Do we have the opportunity to debate that again?
I'm sorry, just for clarity, Councillor, what do you mean to debate what?
So there's three short-term options, but as you would have noted, there's been a lot of criticism that that at least two will be of any use to people in Greater South Dunedin. So I'm just hoping that we aren't wedded to something that may not work.
Well, these projects, and Mr Ward might correct me, but these projects were commissioned by Council on the basis of low cost, no regrets, and that when Council did commit to them, that was on that undertaking. And staff advice at the time was that there may or may not be benefits. That's correct, isn't it, Dave?
Yeah, thank you. That is correct. And so there's an earlier report to Council that describes the risks and opportunities associated with a suite of measures, as had been previously described by a report to Council a number of years ago. And there were some reservations about those particular suite of three. Nonetheless, Council directed us to advance them. That's what we are doing. There will be benefits, and there will be cumulative combined benefits. But to the extent at which one is better than the other, that's for future debate, and we are advancing the works as directed.
What I would say is you get the capital program for your annual plan next week. If there is work that is not in train, Council are free to stop anything at that point. So that would be the opportunity. But I'll make sure that Mr Ward circulates that report, which shows the risk reward of the approach that was taken and the advice that was given.
Thank you.
Councillor Lund, did you have a question, or you're fine? No. Are there any further questions, councillors? There have been none. Thank you again for answering all of those questions. And so I'd like to move that the committee notes the financial performance for the period ended 31st of March 2026 and the financial position as that date. Seconded Councillor Vandervis. And I think it's very reassuring 9 months into the financial year that we're sitting with a very favourable variance, but I would caution councillors that in the current economic environment within which we are at the moment, there are lots of factors at play that will impact I'm sure our result to 30 June. But I appreciate the good work of staff to have us in a significant favourable financial position. Are there any other speakers? There being none, I will put the motion. All those in favour, please say aye. Aye. Against? Motion carried. Item 13, items for consideration by the Chair. Are there any items to be considered? No, there being none. Therefore, I move that the committee, pursuant to the provisions of the Local Government Official Information and Meetings Act 1987, exclude the public from the following part of the proceedings of this meeting as set out on the agenda, and B, adjourns the meeting for 5 minutes. Do I have a seconder for that? Councillor Mayhem. All those in favour, please say aye. Aye. Against? Motion carried. And with that, we'll just take a very quick 5 minutes, councillors, and we'll do this so that we can do this last item before lunch.